All right. Um, so you guys, chapter 5 is the current topic of discussion, and you need to know Appendix A of chapter 5. You need to know that very well. Appendix B is not on the exam, but Appendix A is on the exam. And I remember last time on Tuesday when I was lecturing, I said something like, oh, Appendix A may or may not be on the exam. It is on the exam, and you need to know it inside and out. So I'm going to go over that today. Appendix A is doing the journal entries from the perspective of a merchandising firm or a retailer, assuming that they use a periodic inventory system instead of a perpetual inventory system as we were doing last time. And I may have actually said a couple of things wrong last time. If you recall, whenever I was going over the perpetual system, I got through that. All that was right. But then when I talked about the periodic system, I told you guys what the journal entries would be for the Kaylee company example in the PowerPoints if Kaylee used the periodic system instead of the perpetual system, which we were doing. And I think I said some things wrong about those. So I'm going to correct that today. So what we're going to do first is we're going to go through the chapter 5 PowerPoints, the Kaylee company example specifically. And we're going to repeat those journal entries, but we're going to do it assuming that Kaylee uses a periodic inventory system and not a perpetual inventory system, so that you're very clear on what the journal entries would be. And that is Appendix 5A. It goes through everything using the periodic system. So I'm going to share my screen. Before we do that, let's go to Appendix 5A. And there is an exhibit in this appendix right here. This is Appendix 5A. They go through an example of a company, just like we did in class with Kaylee Corporation. They do a different company's example, different numbers, and they're showing you how to do the journal entries using the periodic system. But at the end of the appendix, they have this Exhibit 5A, which I think summarizes nicely. So given their example with their numbers, if the company was using a perpetual inventory system, these would be the journal entries over here in the left-hand column. And if they were using a periodic inventory system, these would be the journal entries over here in the right-hand column, so that you can see. The key thing to note here is if you're a periodic company, you don't make any entries in the inventory account, either purchases or sales of inventory, until at the very end of the period when you actually count the physical inventory. And that's when you make the entries. You make the entries for purchases and for sales. So during the period when you purchase inventory, instead of debiting inventory like you would under the perpetual system, you debit an account called purchases. Whenever you return inventory that you previously purchased, instead of crediting inventory, you credit an account called purchase returns and allowances. It's a contra account to purchases. Suppose you have to pay shipping on the inventory that you buy. If you were using a perpetual system, you would debit inventory for the shipping cost. You would credit cash. But if you're using a periodic system, you debit a temporary account called freight in. Whenever you pay for the stuff that you previously purchased, under the perpetual system, remember this is a journal entry, you debit accounts payable, credit cash, and the difference, the discount, if you get a discount. If you don't get a discount, you just debit accounts payable and credit cash. But if you pay within the discount period and you get a discount, you credit inventory for the discount. Under the periodic system, you credit purchase discounts. When you sell an item from inventory, under the perpetual system, there are two journal entries. One to recognize the sales revenue, and the other one to recognize the cost of goods sold and the corresponding reduction to inventory. Under the periodic system, there's only one entry. You just make an entry to recognize sales revenue. No entry to reduce inventory or recognize cost of goods sold. Remember, Periodic system, you make no entries in the inventory account until the very end of the period. Suppose someone that you previously sold to returns an item to you. The journal entries under both systems are the same. In terms of the first entry, there's only one entry required under the periodic system. Under the perpetual system, you also have to make another entry to undo the cost of goods sold and the increase the inventory back, because they return stuff to you. But under the periodic system, you don't have to make that entry. And then whenever your customer pays their account off with you, and suppose they pay within the discount period, so you give them a discount, it's the same entry whether you're periodic or perpetual. And so what would happen at the end of all these entries over here under the periodic column, the company would then make another journal entry. Actually, they would make a few journal entries. Purchases, freight in, purchase returns and allowances, and purchase discounts. Those are temporary accounts that don't show up on the financial statements at all, anywhere. So the company has to close their balance to zero, transfer their balance to some account. What account do you think they'll transfer the balance in those 4 accounts to? They transfer the balance in those accounts to inventory. So purchases, they would credit for 21,000, debit inventory for 21,000. That's how the purchases get into inventory. For freight in, they would credit freight in for 126, debit inventory for 126. Purchase returns and allowances, they would debit purchase returns and allowances for 2,100, credit inventory for 2,100. Purchase discounts, it has a balance of 378 credit. They would debit it for 378, credit inventory for 378. And those 4 accounts then would be, their balance would be 0. And their balances would have been transferred to the inventory account. And then another journal entry they would make is the entry to recognize cost of goods sold. How would they figure out cost of goods sold? What they would do now in their inventory account, they have the beginning balance. They have all the purchases in there already, minus any discounts or allowances, and including any freight in if we paid shipping. It's already included in that because remember we've transferred the balances from those accounts to inventory. So we have the beginning, we have the stuff that's added, and then they would go physically count their inventory. They would go in the storeroom, count their inventory, find all those items, invoices, figure out what they originally paid for those items. And that's the ending value of inventory. And then the cost of goods sold is just the plug. It's the X on the right-hand side of the T account. Beginning inventory plus the purchases, the net purchases, plus the freight in or whatever, minus X equals ending inventory. So we know 3 of those things, and we solve for X. That's how they get cost of goods sold. Once they get that number, they would debit cost of goods sold for that number, credit inventory for that number. That's how the periodic system works. So let's do it for the Kaylee company example that we were working through last time in PowerPoints. Let's work through it. Let's open the PowerPoints. And it's chapter 5. And let's jump down to the Kaylee example here. This was the beginning of the example. If you recall, Kaylee purchased 200 cameras that they intended to resell later because they're a merchandising firm for $42,000. If the company uses the perpetual system, there's the journal entry on your screen. If they use the periodic system, remember they don't make any entries in the inventory account until the very end. So instead of debiting inventory, they would debit purchases. So this is Kaylee example from the PowerPoints, but assuming that Kaylee uses the periodic system instead of the perpetual system, which was assumed in the PowerPoints. So the first journal entry would be debit purchases, credit accounts payable for the $42,000. Try to keep things neat here. For transportation costs, if Kaylee has to pay the shipping costs, then if they use a perpetual system, they would debit inventory for the shipping costs, credit cash. If they use a periodic inventory system, they would debit the temporary account called freight in. Debit freight in for 200, credit cash for 200. That's if they had to pay shipping. It says right here for this example, assume that Kaylee does not have to pay shipping. But if they had to pay shipping, the journal entry would be debit to freight in, credit cash, star, assuming they have to pay shipping, which they don't in this example. All right, Kaylee now has 200 cameras in their inventory. Now they decide to return 20 of them. Each of those 200 cameras, when they originally bought them, cost them $210. How do we know that? We take the $42,000 that we originally paid and we divide it by 200. It's $210. So that's important to remember. All right, you return 20 items that you originally purchased, and you haven't paid yet for them. So what's the journal entry if you were using the perpetual system? We would debit accounts payable, credit inventory for the 20 times 210. If we use a periodic system, we would debit accounts payable, we would not credit inventory, we would credit purchase returns and allowances. Purchase returns and allowances is a contour account to purchases. If at any time during this you guys have a question, just stop me and let me know. Discount, purchase discounts. Kaylee pays their supplier what they owe them. They pay their bill off within the discount period. So the terms of this arrangement that Kaylee has with their supplier of cameras is, the terms are 2/10, N/30, 210 N30, which means if Kaylee pays the supplier back within 10 days, they get a 2% discount. And if they pay otherwise, they have to pay the full amount that they owe within 30 days, the net amount in 30. So assume they pay within the 10-day discount period. How much do the question is here, how much do they owe? Well, we originally owed $42,000, right? Accounts payable. But then we returned $4,200 worth of stuff. So now we owe $37,800. So we're paying off that account, that $37,800 account payable. So we're definitely going to debit accounts payable, regardless of which inventory system we use, for $37,800. We're definitely going to credit cash for, since we paid within the discount period, we only paid 98% of that, right? We get a 2% discount. So 98% of $37,800 is $37,044. And the 2% discount, under the perpetual system, we would credit inventory. Under the periodic system, we credit purchase discounts. For the $756, 2% of $37,800. Eventually, this purchase discounts we'll get into inventory, right? When we close out purchase discounts account at the end, we'll debit purchase discounts and credit inventory for 756. Eventually, inventory gets credited for the discount, just not right away, only at the end of every period, because we use a periodic system. So you can see how the entry differs between perpetual system there on your screen versus periodic system. All right, let's go to the sales. So now we have these 180 cameras and we've paid for them. We have a question. Let's see, what is the question here? Can you explain where the 37,800 comes from again? Sure, Ariel. All right, originally, Ariel, we received 200 cameras from our supplier and we owed them $42,000, right? Accounts payable was originally $42,000. Then we returned 20 of those 200 cameras to our supplier. And those 20 cameras originally cost us $210 each, right? 42,000 divided by 200 is $210 each. We just returned 20 of them. So 210 times 20, $4,200 of accounts payable we no longer have to pay. So we debited accounts payable, remember? And so our net balance in accounts payable is 37,800. And that reflects the amount that we owe for the 180 cameras that we have in our inventory, right? We had 200, we gave up 20 back to the supplier. We have 180 left. We owe them 37,800 for those 180, right? 42,000 minus 4,200. You're welcome, Ariel. All right, now we have these 180 cameras. We've paid for them. Now it's time to sell them. Suppose we sell 30 of the 180. Keep in mind, how much did we pay for each of these 180 in the first place? 210. No, that's not true. We did not pay 210. That's how much we owed. How much did we actually pay for the 180 cameras? Well, here's what we paid for them in cash. You divide that by 180, it's actually 205.8. This is the cost that stays with each camera going forward. That's what we actually paid for each of those cameras. That's the cost that we care about. We got to keep that 205.80 in mind. All right, now we sell 30 of our 180 cameras to a customer. And we sell each of them for $500. So if we use a perpetual system, we have to make 2 journal entries. If we use a periodic system, we only have to make 1 journal entry. The journal entry that's common to both systems is the sales revenue journal entry. It's the same journal entry no matter which system you use. Credit sales revenue for the 30 times 500. Debit accounts receivable for the 30 times 500, assuming the customer didn't pay us for them yet, which is usually how it works. So that journal entry is the same. You know, GAAP requires the company to recognize revenue when they earn it. And they earn it whenever they give the good or they provide the service to the customer. So since they ship the 30 cameras to the customer, time to recognize revenue. So that entry has to be made if you use a periodic or a perpetual system. The other entry that has to be made under the perpetual system is the entry to reduce inventory and increase cost of goods sold. 30 of our cameras that originally cost us $205.80 each, we've just sold. So it's time to reduce our inventory by 205.80 times 30, or $6,174. And then that's our cost of goods sold expense. So we recognize that under the perpetual system when we sell the item. Under the periodic system, we make no entry for cost of goods sold expense when we sell the item. We don't recognize cost of goods sold expense until the end of the period. No entry for COGS when we sell the item. We do make an entry to COGS at the end of the period. It's not like we never make an entry, but there's no entry for COGS when we sell the item. All right. So now we have 150 cameras in our inventory. And customers owe us for 30 that we've shipped them. Now suppose that customer that bought those 30 cameras from us, they haven't paid us yet for them. Before they pay us for those cameras, they decide to return 5 of them. What's our journal entry when we receive the 5 back? Well, we have 2 entries under the perpetual system. One entry will undo the sales revenue, because now we no longer can really recognize sales revenue for those 5 because we haven't sold them. I mean, we sold them, but now they're back in our inventory. So we have to, and the customer doesn't owe us for those 5 anymore because they just gave them back to us. So this first entry is the entry that you make under the perpetual system or the periodic system. You have to make that entry under both, which is, you reduce accounts receivable by how much does the customer not owe us now? What do we charge them for those 5? We charge them $500 each, right? So 5 times 500 is 2,500. We reduce accounts receivable. We don't have that account receivable with them anymore for those 5 cameras. And then instead of debiting sales revenue, which would decrease sales revenue, we debit the contra sales revenue account, sales returns and allowances for 2,500. And that has the effect of reducing sales revenue, right? It reduces the net sales revenue. So that entry is what we have to make under the periodic system. And then under the perpetual system, we also have to make this second entry to, undo the cost of goods sold expense that we recognized for those 5 items because they're no longer sold because they were returned to us. So we credit cost of goods sold expense to make the expense go down by 1,029. It's just the 5 cameras times our original cost, 205.80. And then we've got inventory back, right? 5 new items are back in our inventory. So we debit inventory to increase the inventory back by 1,029. It's the 5 cameras times what we originally paid for them before we sold them. Now that entry is not made under the periodic system when your customer returns items back to you that you sold them. So no entry made. So no entry made to undo COGS when customer returns items you previously sold them. And then let's go to the next one. Oh, that's it. The only thing we didn't do in this PowerPoint example for Kaylee is it didn't give us a slide on, all right, what if the customer now pays us for the stuff that they owe us for, which is 25 cameras? What journal entry do we make when they pay us? Whether you use the perpetual system or the periodic system, the journal entry is the same. When the customer pays, you would debit cash. If the customer pays within the discount period, because usually companies offer, after they ship the goods to the customer and they ship an invoice inside the same box, the customer opens the box, gets the goods out and sees the invoice. And on the invoice are the payment terms. And usually the company will offer a discount if the customer pays within a certain amount of time. Because the cash flow is important for companies, right? They don't want all their customers waiting 30 days to pay their bills. They want customers to have an incentive to pay quickly. That infuses cash consistently into the company, right? Because they have, obligations and they have expenses that they have to cover. Their employees are working, they have to pay salaries. Those employees have to be paid a certain amount always, right? You can't tell your employees, sorry, I don't have enough money to pay you. So the company needs cash, and so they'll often induce or provide an incentive for the customer to pay quicker by giving them a discount. So suppose Kaylee gave their customer the same terms that Kaylee had whenever they bought the cameras from their supplier, 210 in 30. And suppose the customer pays within 10 days. So how much would Kaylee receive? Well, how much is Kaylee owed? Originally, we had a $15,000 account receivable with this customer. And then they returned $2,500 worth of stuff to us. So now we have 15,000 minus 2,500. We have a $12,500 account with this customer. And they pay their account off within the discount period. And the terms are 210 in 30. So they get a 2% discount. They owe us $12,500. How much are they actually going to give us? 98% of that. So 0.98 times the 12,500. We're going to receive $12,250 from our customer when they pay us. We got to get rid of their account receivable because we no longer have their account receivable. And their account receivable was valued at $12,500. And looks like we need another debit. And that other debit, we have to reduce sales revenue a little bit more, right? Because up to this point, before journal entry 7, what's sales revenue or net sales revenue? It's the 15,000 minus the 2,500 sales returns and allowances. It's 12,500. But now we gave them a little bit of a discount, so we got to reduce sales revenue a little more. So really, sales revenue, it should be 12,250, right? The cash that we got. And so we reduce sales revenue again additionally, but we don't debit sales revenue, we debit sales discounts. The contra account to sales revenue. Sales discounts for the $250. This journal entry would be made, this is the periodic, we're assuming the company's using the periodic system here, but if Kaylee was using the perpetual system, it's the same exact journal entry, same journal entry whenever the customer pays off their account. And then I hear assumed terms are 210 in 30 and customer pays within the discount period. So customer pays on day, let's say 8. That's within the discount period, right? Then you have to take the 15,000 is what they owe. No, I'm sorry. The 12,500 is what they owe. They owed 15,000, but then they returned stuff to us. So they only owe 12,500 times the 0.98. Gives you that 12,250 number. All right, and that's the Kaylee example from PowerPoints from the perspective of Kaylee if they had using a periodic inventory system. I will definitely post this on Blackboard. Let's see if we have a question. Tanya, number 7 doesn't correspond to any slide. because in the slides, they did not give us a slide for if when the customer paid Kaylee back. And so I created my own slide. So if there was a slide here, what would the journal entry be for Kaylee if they're using, because the PowerPoint's assumed Kaylee uses a perpetual system. In this document, we're assuming Kaylee uses a periodic system. But the journal entry would be exactly the same journal entry, Tanya. And I made up some terms. That's what this is down here. That's why I put it. I said assume that the terms are 210, N30, and so forth. Customer pays within the discount period. You're welcome, Tanya. So definitely when you're studying this chapter back, study this example carefully, both from Kaylee, from the perspective of them using a perpetual system versus the perspective of them using a periodic system. There are quite a few questions on the exam too regarding periodic versus perpetual journal entries. And then this appendix in chapter 5, exhibit 5A-1. Now in this example, this appendix, the numbers you see here are referring to this example right before this. So you have to go back. But this goes through that example both from the perpetual standpoint and from the periodic standpoint, and lists the journal entries for both. Keep in mind there are some extra journal entries for the periodic company after, after these entries. They have to go and close out purchases, go and close out freight in, go and close out purchase allowances, purchase returns and allowances, and go and close out purchase discounts. They have to transfer the balances in each of those 4 accounts to inventory. You don't see those purchases, freight in, purchase returns and allowances, or purchase discounts. You don't see those accounts on the financial statements anywhere. They're just temporary accounts. You might wonder, why do we set them up? So that we can keep track of exactly, this is the dollar value of what we purchased this period. This is the dollar value of what was returned to us this period. Or I'm sorry, the dollar value of what we returned this period. This is the dollar value of all of our discounts that we realized this period for paying within the discount period. We keep track of those things individually with these individual accounts. All right, let's, are there any other questions regarding this example? We have about 50 minutes. Let's work some of the suggested problems. So this will be whenever I upload this to Blackboard, the first thing on here is just the Kaylee example from the PowerPoints. And then we're going to go and add on to this. Let's see here. Let's open. Let's open our handy dandy Word document, which I gave you guys. And in chapter 5, I said we would do exercise 5.4a, exercise 5.9a, exercise 5.6b, problem 5.2a, and problem 5.7a. Let's do, I want to make sure we get through problem 5.7a. So let's do that first. And then with remaining time, we will do anything else, any of these other ones that we have time for. So let's first do problem 5.7a here. So let's go to the book and let's jump ahead to the problem set A. And we're going to go to number 7. Whoops, I went too far. Wait, I'm in the B's. What am I doing in the B's? Here we go. So this problem, and you can see right here, appendix, it's from appendix 5. It's from stuff in appendix 5A. And you know that because it says periodic system right here. So we're going to be basically just doing what we just did for Kaylee, but we're going to have a different company and different numbers, basically. So just to kind of drill this in. The Malvado Corporation sells goods on terms of 210N30. Credit terms for its purchases vary with the supplier. Selected transactions for August are given below. Unless noted, all transactions are on account, so no cash, unless they tell you that it is, and they involve merchandise held for resale. So Malvado's intent is to buy stuff and then mark up the price and sell it. They're a merchandising or a retailer. Another name for a merchandising company is a retailer. They're like Best Buy, for example. Malvado uses the periodic inventory system, it says. All right, what do we have to do? Prepare the necessary journal entries. That's all we have to do. So we got to make an entry for each of these dates. So for August 1st, Malvado purchased merchandise from Norris Incorporated, $2,500 worth of merchandise, terms 210N30. What's the journal entry? We're a periodic company. Do we debit inventory for the dollar value of what we purchased? Yes or no? Do we debit inventory? We're a periodic system company. Nope. Thank you. If you've been listening to anything I said up to this point, no. We don't debit inventory. Good job. We debit an account called purchases. Debit purchases, and it said all transactions were on account unless specified otherwise. So credit accounts payable. We owe the Norris Corporation for this inventory that we've purchased. If we pay within 10 days, we get 2% discount. If we pay within, otherwise we have to pay the full amount within 30 days. August 5th, Malvado paid freight on shipment from Norris, $120. Instead of debiting inventory for the freight, if Malvado used the perpetual system, they would debit inventory for the freight. We debit freight in. And when it's the word paid implies cash. If you haven't guessed that up to this point. It said, assume everything was on account. Well, it said assume any inventory transaction, and this isn't inventory itself; it's the shipping on the inventory. But it did say assuming everything is on account unless specified otherwise. The word paid implies cash, so we'll credit cash. And then August 7th. Now we have some stuff that we can sell. So we sell some stuff to Denton Corporation, and we sell it to Denton for $3,100. Time to recognize sales revenue, right? And it didn't say Denton paid us. So we have an account receivable with Denton. And we've earned $3,100 of sales revenue. August 7th, another transaction. Malvado has just paid the freight on the goods that they sold to Denton. So they shipped the goods to Denton and Malvado paid the freight, $150. And we billed Denton for the charges. Now for this, we would debit something like miscellaneous expense or shipping expense, something like that. Let's be very specific. Let's just say debit shipping expense. And we billed Denton for the charges. So we paid it. It said we paid it, so that assumes that we credited cash. And then we sent them a bill for 150. So they're going to pay the shipping in the end. Now, a company doesn't usually do this sort of a setup where they pay the shipping and a seller pays the shipping and then bills the buyer, and the buyer ends up paying the company back for the shipping that the company paid in the first place. Usually, the company just says the buyer has to pay shipping and includes it in the price of the item whenever they ship. But in this weird case, they're just trying to make sure you understand every nuance. So we pay the shipping and then we send them a bill. So we actually have, let's see, let me think. So the key thing here is we have an account receivable now with Denton because we sent them a bill. They owe us 150. So actually we should debit accounts receivable for 150 and credit cash for 150. And then whenever Denton pays us, then we'll credit accounts receivable and debit shipping expense, because then we've derived the benefit. Right? Remember the definition of an expense being incurred is we derive the benefit from a resource being used. Well, we haven't derived the benefit yet of this shipping because we haven't been reimbursed for it yet. So we want to debit accounts receivable here, and then whenever Denton pays us back, then we'll debit shipping expense or miscellaneous expense if you want to. Companies sometimes have this catch-all account called miscellaneous expense, and it's for little things like this. All right, so that. August 9th, we're Malvado. We returned $400 worth of the merchandise that we purchased August 1st from Norris because it was defective. Norris approved the return. So $400 of our original $2,500 account payable we no longer have with Norris because we just returned the stuff. So we're going to debit accounts payable for 400. Do we credit inventory when we return some of our inventory that we previously purchased back to the supplier and we're a periodic company? Thank you, Michael. No, we don't credit inventory. We credit the contra purchases account called purchase returns and allowances. It reduces purchases. The net purchases is the balance in the purchases account minus the balance in the purchase returns and allowances account. All right, so that's what we would do. August 9th, we received $500 of returned merchandise from Denton. Remember, Denton was one of our customers and we had shipped them, we had sold them merchandise, sold them some of our inventory. But now they gave us back $500 worth of it. So the account receivable that Denton owed us $3,100. So they just returned $500 worth of stuff. So we definitely got to reduce their account receivable by 500. And then $500 of stuff which we originally had recorded as sales revenue, they've returned to us. So we gotta reduce sales revenue, right? And so we reduce sales revenue not by debiting sales revenue, but by debiting the contra sales revenue account, sales returns and allowances. Let's move this over so that the debits are always indented to the, I'm sorry, the credits are always indented to the right, like that. And then 10, paid Norris Incorporated the amount that we owe them on August 10th. What amount do we owe them? Let's see. We originally owed Norris $2,500, but then we returned $400 worth of stuff that we purchased from them. So I guess as of right now, we owe them $2,100. Ariel has a question. What is the difference between that return record? You mean that? I'm not exactly sure what you mean.
Like the one that we just did compared to the other return. Like the one where we debited sales returns and allowances. Why didn't we credit it? Like, what's the difference between each one from like August, both the August 9th ones?
Well, in the first August 9th, we returned something that we purchased from our supplier. And in the second August 9th, we're not returning anything. We're receiving something returned to us that we previously sold to our customer. Two different.
Okay, thank you.
The first August 9th, it's like we're the buyer, you know, and we're returning stuff that we bought. The second August 9th, we're the seller and we're receiving stuff returned to us that we previously sold.
Okay, thank you.
You're welcome. This is a great problem because you get to see from all standpoints, both from the buyer and from the seller standpoint. All right, and then 10th, we pay Norris the amount due. How much do we owe Norris? We originally owed him $2,500, but then we returned $400 worth of stuff. So we only owe Norris $2,100. And we're paying them. And the question is, remember the terms Norris gave us? Norris gave us 2% discount if we pay within 10 days. Is August 10th within 10 days of August 1st? Yes. You just take 10 minus 1, and if it's greater than 10, then it's not. If it's less than or equal to 10, it is. So 10 minus 1 is 9. Yes. So we're going to get a 2% discount. So we owe them $2,100, and we're paying off our account. So we're going to debit accounts payable, $2,100. How much cash, though, do we have to pay off that account? Since we paid within the discount period, we only have to pay 98% of $2,100 to satisfy the account. So we pay them $2,058. And it looks like the discount is $42. And we credit purchase discounts. It reduces the value of our purchases a little bit more, right? So I should put a star by this. Star is the account payable that we owe multiplied by the 98% that we're paying. If we did not pay within the discount period, like if we paid on August 13th, then we would just debit accounts payable for $2,100, and we have to pay $2,100, right? We would credit cash for $2,100, and there would be no credit to purchase discounts because we didn't get a discount. August 14th. We buy some more inventory, this time from the supplier Chambers Incorporated. And we buy $4,500 worth. And the terms are 1, 10, and 30. So they're not as good of a supplier. They only give you a 1% discount if you pay within 10 days. That's fine. So the journal entry for this one is going to look very similar to the journal entry on August 1st, just different numbers. We're going to debit purchases and we're going to credit accounts payable. For, what was it, 4,500? August 15th, we pay freight on the shipment from Chambers, 160. So that's going to mirror when we paid the freight on the shipment from Norris. Debit freight in, credit cash. August 17th, we received the amount due from Denton Corporation. What amount is due from Denton? We had sold merchandise to Denton on August 7th for $3,100. We had paid some freight on shipping the goods to Denton for $150, and we billed them for the charges. But then Denton gave us back on August 9th, they gave us back $500. So really they only owe us the $3,100 minus the $500, plus the $150 for the shipping, right? We'll keep the shipping separate. The $3,100 minus the $500 is our account receivable with Denton, plus the $150. That's all part of the account receivable with Denton. So what is that? 2,600, and then an additional $150. So 2,750. And if you look here, accounts receivable relating to Denton, 3,100 here, 150 here. So that's 3,250. And then Denton returned $500 right here. Then we credited accounts receivable. So that's 2,750. So we just received that from Denton. We've just received the payment on that account receivable from Denton. So we know we're going to credit accounts receivable for 2,750. And we know we're going to debit cash for the amount that we received from Denton. Now, did Denton pay within the discount period? This is the 17th. We sold the stuff to them on the 7th. And it says we provide terms to our customers of 2, 10, and 30 up here in the instructions up here. And so it looks like the 17th minus the 7th is 10 days or less. So yes, Denton was going to get a discount. So Denton doesn't have to pay us the full 2,750. They only have to pay 98% of that. But let me think carefully about this. We kind of need to separate the freight that Denton owes us, the shipping stuff that we billed them for, and the original items. The freight, they don't get a discount on that. They only get the discount on the original items. So what's our account receivable just for the original items? It's 2,600, right? So the 2,600 times the 98%. We get that from Denton to pay off their account for the items. But then we also get the 150 that they owe us for the shipping. And so this is what the cash we get from Denton. Should be. This was, but then we would have debit. Yeah, this is right. This is right. I'm combining this into one journal entry, but I believe the answer key combines it into two. One for the shipping that they're paying back, and then one for their account. I'm combining it into one journal entry. So yeah, that's the amount we received from Denton. And then we would debit sales discounts for the amount of the discount they received. We need actually 3 debits. What discount did they receive? They owed us $2,600 and they only have to pay us 98% of $2,600 for those items. We're not talking about the shipping. 2,600 times 0.02, the discount is $52. And then the 2698 oh, so we need another credit. I'm confused. All right, scratch this. I believe I've combined, to make this make more sense, I'm going to do 2 separate journal entries. Denton owes us $2,600 for the stuff they bought from us, that they still have, that they owe us. And they also owe us $150 of shipping. Let's take care of the $150 of shipping. For that, we debit shipping expense, and we credit accounts receivable with Denton, $150. Let's do this in 2 journal entries just to make this so we don't get confused. All right. Denton also owes us $2,600 for the stuff, and they pay within the discount period. So we're going to debit cash for $2,600 times 98%, or $2,548. We're going to debit sales discounts for $52, and we're going to credit accounts receivable for $2,600. That takes care of everything relating to Denton. Here they pay back their shipping that they owe us, that we billed them for. I mean, we pay the shipping for them, but then we bill them for that. And then here they're paying back what they owe for the items that they have from us. Hopefully that makes sense. Sorry, I started doing that in one journal entry. You can do it in one journal entry, I think. Debit cash $2,548, debit shipping expense $150, debit sales discounts $52, and credit accounts receivable for $2,750. That would have done it in one journal entry. I don't know why I was struggling over that, but then it's not as intuitive if you're looking back trying to study for this. You'd be like, where do these numbers come from? All right, that was too long on that. Gongbin says, in this case, did you need to change the journal entry when the company billed 150 to the company? No, the journal entry when we billed Denton for the shipping is up here. It's just, this was the journal entry when we paid the shipping expense we paid UPS, we make that journal entry. Credit cash, debit, accounts receivable to Denton. Because we turn around and send Denton a bill for that. And then when Denton pays that off, which is right here, then we credit the account receivable and then we debit the shipping expense. It's not an expense to us until we recognize a benefit of it, right? You only incur an expense when you derive benefit from using a resource. In this case, we got the benefit for getting paid back by Denton, from originally having to pay for the shipping. Hopefully that makes as much sense as possible, Gongmin. Another thing that would make this problem easier, which I'm not doing, which they do in the answer key, we're Malvado Corporation. Each supplier we have a separate account payable with that supplier. So this T account should be account payable dash Norris. To keep that separate from the, whenever we buy from a different supplier down here, right here, this was account payable dash Chambers, right? Same thing with accounts receivable. We have accounts receivable for Denton, and then we have accounts receivable for other customers. And then we add up all those individual account receivable accounts to get the total account receivable. Same thing for the account payable. That would make this problem a little bit easier to follow. I'm just using the one account, keeping track of it in my head. But anyway, hopefully this is making some sense. I think it is. I think that I've done a pretty good job of explaining this step by step. All right, August, whoops, I opened Excel. August 18th, we sell merchandise. So here's our second customer in this example. All right, Denton's already paid us. They were our first customer. Everything's fine with Denton. We don't have any more account receivable with Denton. Now we sell merchandise to Weber for $4,800. And it's just like when we sold to Denton. It's going to be the same journal entry. This was the Denton journal entry. We're going to debit accounts receivable for $4,800, credit sales revenue for $4,800. Now we're selling to Weber. And then on the 20th of August, we pay freight on the August 18th shipment to Weber, $160, and then we bill Weber. So now the journal entries are getting redundant. We've already done this. We're going to debit accounts receivable. If we didn't bill Weber for the shipping, we just covered ourselves, we would debit shipping expense right there, credit cash. But since we're billing Weber, we debit accounts receivable for $160, credit cash for $160. This journal entry is a little non-intuitive because when do you have to pay cash to someone at the same time debit account receivable? Like we're paying UPS, the shipping company, but since somebody else is going to pay us back for that, that's probably debit accounts receivable. Hopefully that makes sense. It's a little bit non-intuitive. And then on August 24th, we paid Chambers the amount that we owe Chambers. Wait, Tyler says, you would debit shipping expense. Let's see, what is he asking? Is it a question or is this a statement? I think it's a question. Would you debit shipping expense rather than the freight in account if you had to pay for the shipping? No, Tyler, you're confusing things. We debit freight in for whenever we pay shipping on stuff that's coming to us. But whenever we pay shipping on stuff that we're sending to other people, we would never debit freight in. Freight in means it's coming in to us. We would always debit shipping expense. Tyler? It's like comparing apples to oranges. You know, the August 5th transaction, it's shipping on what? It's stuff that we purchased that's coming to us from Norris. Debit freight in. Eventually those dollars will get put into the inventory account, our inventory account. But the shipping on the stuff that we ship to Denton, for example, or to Weber, the $150 and $160, if we're not going to bill them for it, we're just going to pay it, ship the goods to them and pay the shipping, then it would just debit shipping expense. If we're going to bill them for it, then we debit account receivable, and whenever they pay it off, then we debit shipping expense. Eventually, we debit shipping expense for the shipping that we pay on stuff that we ship out. All right. August 24th, we paid Chambers the amount that we owe Chambers. So on the 14th, we bought some stuff from Chambers, $4,500. Did we return any of that stuff that we bought from Chambers? No, it doesn't say we returned any of that stuff. Up here, when we bought stuff from Norris, we did return $400 worth of stuff. So that was a complication. But down here, our supplier Chambers, we buy $4,500 worth of stuff. 10 days later, we paid Chambers for that stuff, and we never returned anything to them in the meantime. So we owe them $4,500. We're paying off our $4,500 account. So we're debiting account payable for $4,500. We no longer have this account payable with Chambers now. And how much do we have to pay? We're going to get a discount, right? Because you pay within the discount period. We're going to get a 1% discount. So we're going to pay 99% of $4,500. So credit cash, and then credit purchase discounts for the difference. So $44.55, and then $45 is the discount that we took advantage of. And then finally, on August 28th, we received the amount that Weber owes us. And again, this August 28th entry, we're going to put it into two entries. It's very similar to this, what we did here. Part of what Weber owes us is for the $160 of shipping that we billed them. And part of what Weber owes us is on their account receivable. And so let's do that into two journal entries. So for the shipping part, we'll debit shipping expense. Whoops. We'll debit shipping expense. And credit accounts receivable. We originally set up this account receivable with Weber for the shipping that we paid on the stuff that we shipped to them. So now they're paying us for that shipping that we originally paid on their behalf, so we can get rid of the account receivable with them. And also they're paying what they owe for the items that we shipped them. What do they owe for those items? Originally $4,800. And it didn't say that Weber returned anything to us during. With Denton earlier, Denton was our first customer. They originally owed us $3,100, but then they returned $500 worth of stuff. But with Weber, they originally owed us $4,800, August 18th, and they haven't returned anything. So they owe us $4,800, and they're paying off their account. So we're going to credit accounts receivable. We no longer have an account receivable with Weber for the stuff that for the items. And how much cash do we get from Weber? It's August 28th, they paid us. August 18th is when we sold the stuff to them. Our shipping terms are, our terms we provide to our customers are 210 and 30, so they're going to get a 2% discount. So we're only going to get 98% of the 4,800. So 98% times 4,800. 4704. And the difference is debited to sales discounts, which is a contra sales revenue account. The difference being $96, it looks like. Move this over. I like to keep the credits indented over here to the right, debits to the left. So these two journal entries would be made when we receive Weber's payment. All right, and it doesn't give us any more transactions, but I do want to go over what would Malvado do now at the very end of August. Suppose that is all these transactions that you see here are all the transactions that happened during the month. What journal entry? So I'm going to ask a question here. Oh, I should put a star by this. I didn't write down how this is calculated. Star was the $4,800 multiplied by the 98% since they paid within the discount period. All right. We have a question. How come on the 10th we didn't put purchase discounts in the journal entry? On the 10th. We did put purchase discounts in the journal entry. It's right there. No problem, Tanya. Good pickup, though. If you thought that that wasn't there and it needs to be there, you're right. It does need to be there. All right. What other journal entries does Malvado need to make at the end of the month? Nowhere in these journal entries have we done anything to increase inventory for the purchases or decrease inventory for the sales and recognize cost of goods sold expense, right? You haven't seen inventory or cost of goods sold expense in any of these journal entries since Malvado uses the periodic system. So now we need to these extra journal entries here that we need to make are going to do that. So what we do is we take these 4 accounts: purchases, freight in, purchase returns and allowances, and purchase discounts, and we transfer their balance to inventory. So make their balance 0, transfer it to inventory. That's the first thing we do. So let's take these 4 accounts. I'm just going to abbreviate because it's just too much writing. So purchases has a balance of, let's see, $2,500 here when we bought stuff from Norris. Where else did we debit purchases? $4,500 here on the 14th when we bought stuff from Chambers. So those are the only 2 purchases we made. $2,500, $4,500. So purchases is sitting here with a $7,000 debit balance. But we need purchases to have a 0 balance. Same thing with purchase returns and allowances. Purchase returns and allowances, we first credited it for $400 right here whenever we returned stuff to Norris that we previously bought from them. And that was the only time we returned stuff. So it's sitting there with a $400 credit balance. Purchase discounts. We paid Norris back on August 10th. We realized a $42 purchase discount. And we paid Chambers back on August 24th, and we realized a $45 purchase discount. So purchase discounts is sitting there with a balance of $87 at the end of August. And then freight in we debited twice. Once for the stuff that we, the shipping cost we paid for Denton, which was $150, I remember. And the other one was the shipping cost we paid for, who was our other one? Oh, Weber for $160. So freight in is sitting there with a, what is that, $310 balance. Now keep in mind, these 4 accounts, they're all temporary accounts. Their balance has to be close to zero at the end of the period, and these accounts don't appear on the financial statements. So we're going to close out these accounts. So what we're going to do is we're going to make a journal entry to close out the purchases account. We're going to debit inventory for 7,000, credit purchases for 7,000. So now we credit purchases for 7,000. It has a zero balance. We're going to debit purchase returns and allowances for 400. So now it'll have a zero balance. And we're going to credit inventory. See, the book doesn't talk about these last entries. It doesn't even mention them. It just assumes that you would guess what they are. But I won't do that. I'll just go ahead and give them to you. And then for purchase discounts, it has a credit balance of 87. So we got to debit it for 87, credit inventory. And then for freight in, it has a debit balance of 310. We need to make the balance zero, so we got to credit it for 310. And that means we got to debit inventory. Freight in does eventually get into the inventory account under the periodic system. Just takes a while. And now each of these four accounts has zero balance, and inventory has now been updated. So let's look at the inventory T account. Suppose they gave us the beginning balance in the account. I'll just pick a number. It was $1,000. Suppose given the beginning balance of 1,000. Then we made these adjustments to inventory at the very end of August. $7,000 debit, $400 credit, $87 credit, and a $310 debit. And I'm almost running out of room here. You know, I should probably put this on the next slide, on the next page, just so that I have enough room. We are almost done. And I think this problem gives you everything you need to know from this chapter about the periodic inventory system. Now, the slides do a good job on the perpetual side. And then let's just give ourselves a little more room here. So this is 310. And then the ending balance. All right, so suppose you were given the beginning balance was 1,000. Then you were given all these transactions, and those transactions led us to make these four adjusting entries to inventory at the end of the period. One to close out purchases, one to close out purchase returns and allowances, one to close out purchase discounts, and one to close out freight in. You're given 1,000. And now the company, they need to compute their cost of goods sold. The cost of goods sold is the amount that went out total. Suppose they went and counted their inventory, and they found that the dollar value of their inventory is at the end of the period, at the end of August, the dollar value of the inventory is, let's say, $2,400. Then the company would calculate their cost of goods sold using the T account formula. So $1,000 plus the 7,000 minus the 400 minus the 87 plus the 310 minus cost of goods sold expense has to equal the $2,400. And that implies that COGS for the August, so this 2,400 is arrived at by a literal physical count at the end of month. So that's where this 2,400 comes from. You go count your inventory. You count all the items, and for each item you have an invoice, what you originally paid to the supplier for that item. You add up all the dollar values, $2,400. And you back out the cost of goods sold. So cost of goods sold expense, 2,400. No, it'd just be 1,000 plus 7,000, so 8,000, minus 400, minus 87, plus 310, minus 2,400. So 5423 would be the cost of goods sold expense. And then you would make one final journal entry. Debit cost of goods sold expense for 5423. Credit inventory. 5423. So hopefully you can see why companies don't really like using a periodic system. There are more journal entries. There's more stuff to do. At the end of every period, you got to go physically count your inventory. And at any moment during the period, you can't look in the inventory T account and know exactly the dollar value of inventory, right? Because you don't make any entries in the inventory T account until the very end. So that basically, this is Chapter 5 Appendix. And on Tuesday, we discussed regular Chapter 5 Perpetual Method. I know we didn't have time to go over, all the problems. We only went over one of these problems, but we went over 7A. But I feel we did a good job of highlighting the differences between the two methods. Definitely take a look at that exhibit in the appendix, which discusses the differences between the journal entries. Are there any questions? This chapter also has a couple of other concepts that we didn't talk about in the problems today. Just those ratios, right? Return on sales, which you already know that from previous chapter, we did that. And then the gross profit percentage, which is just the gross profit divided by net sales. But I didn't feel like we needed to do a problem over those things. It's just ratios. You should be able to calculate those things. The things you guys have trouble with are the journal entries, so that's why I focused on that. Of course, for exam 2, if we have the review session, if you want me to do some other problems from this chapter, I can, since I didn't get to most of them. But I spent my time on the things that I thought were the most important today. The things that would trip you up the most in the future, what I thought you would trip you up the most. All right. If there aren't any other questions or any questions at all, I mean, you guys asked a few going forward. You guys are just processing all this information. Just go and study over the weekend. You guys did well as a class on exam 1, so just keep doing what you're doing. And I will see you guys next week. Have a great weekend.